The tick grid in combination with price is very helpful to read price action in real time and understand if the algo wants to price up or down. It's not just for the SPX, but for all stocks on the New York Stock Exchange, because price is done on the stock level. Don't just use tick grid blindly without understanding it, because else you will make many false decisions. Neither knowing all the DR models, for example, nor the tick grid only will make you a profitable trader. It's a combination of everything and kind of an alignment from several confluences, where each one of them supports a trade idea if used correctly. Everything I give you as a tool should help you to increase your probabilities of a trading decision. That's the goal, to stack the probabilities as high as possible. First of all, what is the tick grid? The tick grid is an indicator that shows the New York Stock Exchange tick index. Everything is done and decided in the US during the regular defining range. Every other index like the DAX, FTSE, etc. are literally puppets from the US when it comes to price movement. The tick grid shows you the number of stocks trading on an uptick minus the number of stocks trading on a downtick, and is used by day traders to view the overall market sentiment at a given point in time. To simplify, it shows you how many stocks are sold or bought right at the moment on the New York Stock Exchange when price is moving. Since the tick index measures the up and down ticks of a universe of stocks, any collection of stocks could theoretically have its own tick index. Some of the major tick indices are the USI tick for the New York Stock Exchange, the USI tick Q for the Nasdaq, and the USI ticky for the Dow Jones. Tick indices are available in Tradingview as a symbol, just like any other stock, which you can show on a chart. How to get the indicator? Head over to Tradingview and click on Indicators. From there, you select the Community tab and search for Tick Grid, where this one should pop up. Make sure you favorize it. If you are super lazy, I added a link in the video description as well that directs you to this Tradingview indicator. Once done, this script adds a pane with your selected tick index, which can then be used as an indicator to make short-term trading decisions. Open the indicator settings and show inputs. You can customize the tick grid indicator however you like in terms of color and style. Leave the inputs for the levels as they are. The default ticker is the USI tick for the New York Stock Exchange and can be changed at any given time. Now that you've customized it to be perfectly visible for your eyes, it is important to understand what those levels and values mean. For demonstrating purposes, I will use this illustration before we jump back to the charts. As you can see, there are 5 lines visible in the tick grid. The dashed line represents the tick value of 0. The upper green line represents the positive tick value of 800, and the lower green the positive tick value of 600. The lower red line represents the negative tick value of minus 800, and the upper red line the negative tick value of minus 600. The upper levels are the extreme to the upside, and the lower levels are the extreme to the downside. A positive number means net. It's a delta of stocks being bought or sold. If it's, let's say, just right above the midline, net basic around 200 stocks are being bought. It's not just for the SPX, but for all stocks on the New York Stock Exchange. If the tick grid reaches the lower levels, for example, you can either expect a retracement or a turnaround in price. Let me show you how to use it. First of all, use it only in the regular trading hours for the equity markets. The tick grid is telling you quite nicely when a manipulation is happening. This is where we come to the divergence in price versus tick. Before I continue, I would really appreciate some feedback. Leave a like or a comment and let me know if you enjoy these kind of videos and want more. In the top pane, you have the price chart of the E-mini S&P 500 futures chart ES in the continuous contract, and in the lower pane, you have the tick grid indicator using the USI tick of the New York Stock Exchange. A bullish divergence. Tick is making a new low while price makes a higher high. That could be a point where the algo is switching gears from pricing down to pricing up, or it signals you that price wants to retrace. It means that the retracement is finished and we most likely tick up. Ideally, you want to have the tick in the lower extremes there. Several confluences should align for your long trading idea, and then you ideally want to press the button when tick grid is in the lower extremes. Here is an example from the last Tuesday regular trading session. If you are familiar with my basic DR teachings, you should know that the probabilities for a trumpet price action after the ADR and ODR session are already high in this case. But let's focus on price versus tick in the RDR session for now and how you could have spotted a nice setup using the tick grid. We obviously get a long confirmation at 10:40 a.m. Price retraces after that and is moving around the closing price of the RDR session. But what else is happening? While price is making a higher high and rejecting the closing price to the tick, we get a lower low in the tick grid reaching for the lower extreme. That's a divergence right there. If we turn on volume and gap imbalances, the picture gets even clearer. A beautiful cluster right at the current price action, which can be used for stop-loss placements as well. Since it was a very fast movement, you could have just trusted the most recent retracement low and place your trade anywhere like this for at least 3R, targeting the 1 standard deviation. On the 1-minute chart, the picture gets even clearer. In this case, it would have been much easier to place your order accordingly. Here are a few more examples of a bullish divergence. A bearish divergence. Tick is making a higher high while price makes a lower high. That could be a point where the algo is switching gears from pricing up to pricing down, or it signals you that price just wants to retrace. It means that the retracement is finished and we most likely tick down. Ideally, you want to have the tick in the upper extremes lining up with several other confluences for your short trading idea before you press the button. Here's an example. We have our DR short confirmation and price retraces back to the DR and IDR lows, which also align with the previous session lows. While price is making a lower high, we get a higher high in the tick, reaching the upper extreme levels. Price drops, and while it reaches the next standard deviation level of 1.5, it also reaches the lower extremes of the tick. Here are some other examples. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7dr.com for more information. A fake high. First of all, you see a fine movement of the algo, where it's pricing up in sync with the tick until to a certain point, where it's overextended. We get a higher high in price while we are hovering at the upper extremes of the tick grid and making a lower high in the tick grid at the same time. That's a divergence at the top where we know with a high probability that the last high in price was a fake high to make people think to go long. It can be used to spot fake highs in price or a fake high inside a retracement. This example is from last week's FOMC news day. We make a new high in price while we are hovering at the upper extremes on the tick grid at the same time and not being able to make a higher high in the tick. Here's an example of a fake high inside a retracement. We have a DR short confirmation and price comes back to the DR low, but decides to have another push higher to the closing price of the RDR before going lower. While this happened, we were at the upper extremes in the tick but didn't see a higher high. That's a good indication of a fake high inside the retracement, since we are bearish. A fake low. First of all, you see a fine movement of the algo, where it's pricing down in sync with the tick until to a certain point, where it is overextended to the downside. We get a lower low in price while we are hovering at the lower extremes of the tick grid and making a higher high in the tick grid at the same time. That's a divergence at the bottom where we know with a high probability that the last low in price was a fake low to make people think to go short. It can be used to spot fake lows in price or a fake low inside a retracement. In this example, we have a DR false day, where both directions get a confirmation. At the end of the session, price makes a lower low, while tick doesn't follow up and hovers at the lower extremes. Also, if turning on volume and gap imbalances, we can see that there is a nice reason behind that fake low. Here's another example from a fake low inside a retracement. We have a DR long confirmation and price is clearly rejecting the IDR mid several times. We have one last push lower in price and an immediate close above the IDR high, while tick is not making a lower low. That's a strong signal, especially with the immediate close above the IDR high. On really trendy days, it may only get to around 0. Obviously, you don't go always long when the tick grid is in the red area, and of course vice versa for shorts. That would not make sense, as it's not the holy grail to trading. This is very hard to be manipulated as it's the real price action. All you see in the tick is how many stocks in the delta are ticking up or ticking down. Nobody is talking about this and teaching about the grid anyway, but the point is, yes, stocks can be manipulated, but it's way harder to do stock manipulation than, for example, the futures price. You can way easier move the futures price for a few ticks than the stock market. It's over 800 stocks, let's say, and if you want to fake or hide what you're doing in the market, it's easier on the futures, but it's almost impossible to do that with 800 stocks. And that's why we see these divergences inside the tick compared to the price. Even though the technology is crazy good, the algo can't hide the movements in there. So basically you want to find a setup with your confluences and ideally see that the tick grid also aligns as an extra confluence. Don't make it all dependent on the tick grid. It's not the holy grail, it's again just another great tool which should serve as an extra confluence. A lot of understanding comes just from watching how price and tick grid moves together. It should just be used as an extra tool. We can use the tick grid to find the right entry inside a good retracement area where other confluences like an open volume or gap imbalance, previous DR levels or whatever your strategy is, align. Don't just blindly apply this tool without studying it first. I would suggest you to go to your charts and add it like I've shown you as an extra pane to your chart. Just watch it for a few weeks in the IDR session and take notes, study it, and write down what you observe. Don't take any trades based on the tick grid for the beginning. You can also backtest it. Check what happened to price versus tick in the past. That's what backtesting is actually for. 0% risk, 100% learning and refining. We're gonna take on the world.